Okay, great. So that answers the first question. Will this be recorded? Yes, and we will share it with you. Yes. Welcome, everyone. My name is Corinne Goebel. I'm the CEO of the Association of Women's Business Centers. I'm so happy to have you here and really want to thank Cambridge Credit Counseling, their team, as well as the AWBC team for making all of this happen. And thank you all for being here and taking a step toward improving your position with your credit, presumably, so that you can get access to funding, otherwise known as capital. I'll be introducing our subject matter expert, a real, I'm going to say veteran, probably has seen and experienced and heard about every possible thing out there. Marty, so glad to have you, Marty, president of the Financial Counseling Association of America, director of education compliance manager at Cambridge Credit Counseling. And he's been so transparent, just sharing his contact information here, but we can come back to that just a moment. Before we hand it over to Marty, I'm going to kind of set the stage for today. We are not here to lecture. We're not here to speak at you. Our desire for you is to get a hands-on opportunity, a workshop opportunity. And today's session is the first of 3 so that we can really hit all of the questions. And I know you have them. Thank you so much for submitting really thoughtful questions in your registration paperwork. I've been going through those questions and I'm excited to be able to address some of them here and also point to which session you're going to get in-depth answers to several of those questions throughout this 3-part series. So this is a collaborative effort. You're doing your part, we're doing ours. We're all working together to get you the knowledge you need to master your credit by utilizing the tools of the credit system. Of course, we are not here to judge you or your business practices. At the same time, keep them confidential. If you have questions, try to keep any of your personal details right out of it, just so for privacy sake. Our goal is to help you. We know in many cases you either have a business or you may be planning to start a business, and having the healthiest possible credit that you can get is going to move you forward in your business growth, and that's our mission. So we want to help you address any problems that you have and help you improve your credit to secure, as I said, any funding that you may be looking for in the future. So we have devised 2 fictitious characters, and they're intended to be gender neutral. We may slip up or something and use the wrong pronoun, but we don't want to assign any gender here. These are fictitious characters. Could be a man, could be a woman, could be me, could be you, could be anyone here, right? But we're going to use names so that we can easily talk about them in this fictitious story, but using kind of a real world example of how credit is going to affect different business owners. As I prepare to jump into that, I do want you to know that we've got an active chat, and because I'm not able to see the chat effectively, Jackie, can I appoint you to surface questions and make me aware of anything happening in the chat? Okay, great. Okay, so first we have Jordan Rivera. Jordan owns and operates their own custom woodworking shop. And then we have Alex Carter, who owns a cleaning service. So Jordan and Alex, both business owners need some financing to grow their business. And we could imagine what kind of funding they might need to expand. But I guarantee you, at some point in a business journey, every business needs capital. And I dare you to prove me wrong. Find me a business that is able to grow without any form of capital. I can't wait. I can't wait to learn. Somebody prove me wrong. In order to get access to that capital, they will need a strong credit profile. And every person's profile is unique based on the experience and history that everyone has. But we may discover that there are some parallels between these folks and maybe your own story. So over the course of these 3 sessions together, today being the first one, you're going to see what each of them needs to do to move forward and grow their business. And we hope this is obviously instructive for you. Okay, so, I've advanced too fast. So before we advance beyond Jordan and Alex and start learning more about them, let's learn a little bit about ourselves. So I'm going to ask Jackie to pull up the poll, and we are just doing a quick check of ourselves to try to think about. And by the way, this no one here is going to see. None of the participants are going to see what you're selecting for yourself. The poll is anonymized for the purposes of just sharing the statistics, and you get to assess just kind of where you think you might be. If you're unsure, that's totally fine, but you might have some idea, some small guess. So that's what we're looking for here, is to please just, let's see, we've got 20 out of 28 people have responded. So I'm looking for just a couple more. We're now at 22 of 28. We're almost at the 80% mark. Okay, we're at 82%. I'm going to give it 5 more seconds. We're not doing a bunch of polls today. This is going to be the one chance that you've really got to come in and engage and measure yourself. So great. Congratulations, everyone, for thinking about your credit, what your credit health is. So it looks like today we've got about a third of you believe your credit's excellent. So congratulations for that. Just under a third are suggesting their credit health is good, and then 20% at fair, and 16% is poor. And no matter where you think you are today, we're going to be able to provide some great resources and information that is going to be helpful for you. Jackie, I'm going to leave it up to you if you want to share poll results and all of that. I'm going to move on here with our slides, if I can. Okay, Marty, this one's you. Why does credit matter for your business? Thank you for joining us, and the floor is yours.
It's my pleasure, Corinne, and thanks for bringing us together. I've worked with individual women's business centers. More important, it'd be remiss if I didn't mention that I am married to a women's business owner, very successful. I think just passed her 15th year in business. And I can tell you from experience that starting out is a unique path for everybody. And the advice you get from different corners may or may not be useful and may lead you in the wrong direction. Uh, but why we're here today is to learn the fundamentals, how to improve credit. Your credit is a fluid situation at best. So for all those people who said they have excellent credit, it's not necessarily going to stay that way. You have to understand that periodically when you need financing, your credit may take a dip. And that's only natural. And for those of you folks who listed yourselves as having poor credit, that's just a momentary thing. In fact, over the course of these sessions, we can show you how to improve your credit in a relatively short period of time, depending on a couple of factors: how much money you have to work with, what types of accounts you currently have open, et cetera. We'll go into that as we move forward, but all of those things are vitally important for your business because you need access to financing periodically. You want to be able to take opportunities and seize on opportunities when they are available, and not having access to cash or having access but at very high rates of interest is going to hamstring your business. We don't want that. So we want to know how to get our credit into a great place and know how to keep it there. But to do that, we have to understand the basics. And there are a lot of myths out there. I regularly encounter folks who work for credit unions and banks locally who don't have a thorough understanding necessarily. So that's why we're here. We're going to go through it. We have a lot of slides. We're going to move quickly. If you do have questions, please put them in the chat and we'll try to address them at the end. We're going to save some time for Q&A. But first we have to make sure we get there. So next slide, please. Okay, so the first step always, and the first question I always ask folks who are turning to us for credit help is, what's in your reports right now? When's the last time you looked at them? You can get your reports free every week right now at annualcreditreport.com. I realize a lot of you probably use Credit Karma. I do have a slide about that, but It's not the same. You only see two out of your three reports there. You see all three at annual credit report, and they're free every week. It used to be once a year. During the pandemic, they made a change to once a week. Uh, about a year and a half ago or so, they decided to just extend that benefit for good. So let's take advantage of it. You don't need to see it necessarily weekly, but every month when your business is growing and improving, might be okay. Um, you do want to make hard copies of your reports periodically so you can, if there are mistakes or you have questions, you can flag them and ask me. I'm always available and my counseling is free. So next up. You mentioned Credit Karma is a great site. I joined it when it first started, I am proud to say. In the beginning, it was basically in black and white. It looked like it was designed by some really sharp eighth graders. Now it's a beautiful site. It's got lots of great information, but you're only going to see your TransUnion and Equifax reports there, and you're never going to see a FICO score there. FICO is an independent company. The credit bureaus have to buy access to FICO's algorithms to produce a score in the first place. At one point, they thought, hey, it would be nice to squeeze FICO out of the picture. They created their own algorithm. That's called Vantage. It's very similar to FICO now. For a while, it was more consumer friendly than FICO. So FICO has actually responded to the competition in a positive way. But FICO is more widely respected. More than 90% of lenders use FICO. A much smaller percentage, less than 20%, would acknowledge a Vantage score. That can change over time. It's not a bad idea to use the site. You can always compare the scores to each other, but Credit Karma is not a FICO score. Next up. FICO is not a credit bureau. A lot of folks are confused about that. It's just a data analytics company. Its formulas evaluate the risk that loan applicants represent. It saves lots of legwork and investigative time for lenders and loan officers who used to have to go talk to your neighbors and talk to your employers. My grandfather was a banker, and that was probably the least favorite part of his job, even though he was in a small town, he already knew everybody. Um, the nicest thing about credit scoring is that it takes bias out of the equation. Uh, Now, FICO scoring, actually, the two principal owners of the company and founders of the company met in 1956. They each invested $400, probably the best $400 those two ever spent. But notice that FICO scoring on a general purpose basis only came about in 1989. So for 32 years, those guys were sitting on a gold mine and didn't quite know how to bring it to the masses. So, we think of FICO as, boy, they're really sharp about their business, but they struggled too. They didn't know how useful their product would be. They tried to shop it to individual companies for a while. Uh, they're a great success story, but they were not without their struggles either. A couple things we're going to point out about FICO along the way, but the most useful one to you is that if you think of Microsoft Windows, what are we on now, Jackie? Windows 11? Is that the latest, the current version? And you notice that when when Microsoft produces a new operating system, there's a lot of fanfare. And they'll say, "Oh, everybody switch to Windows 11." And oh, by the way, stop using Windows 3. We're not going to support that anymore. There'll be bugs and security risks. Don't use it. FICO never does that. All of the formulas they've created are still in use. And you're going to encounter that when you use a service like CreditWise, which is a great service. It's a Capital One service. You don't have to be a Capital One client to check your FICO score there. It uses FICO's eighth formula. Now, you may go car shopping this weekend and you check your score on CreditWise before you go and discover that it's 700. And you get to the car dealership and they say, they work with 3 local banks. They fax off your application. They come back and say, good news, we can get you a loan. Your score is 691, so that's good. And you're steamed instantly because you think, no, it's 700. I just checked it 20 minutes ago before I drove here. I didn't buy anything in between. It's 700. Don't try to cheat me. It has nothing to do with that. They just, the banks they worked with used an older version of FICO. That's going to happen in your business experience and your personal credit experience constantly. Don't get worked up about it. Know that all those formulas are still out there and still being used. Next up.
Am I talking about Jordan?
Yep.
Okay,
Yep.
great. Making sure. Okay. So enter a fictitious Jordan as a scenario here. Remember, Jordan's the one with the woodworking business that's growing, and Jordan's got a recurring contract that could be available, but they would need to acquire a piece of equipment, machinery, a CNC router. If y'all know what that is, if you don't know what it is, doesn't matter, but it's going to cost $40,000 to get this piece of equipment. And it just wouldn't make sense to blow that amount of cash, even if they had it. It's going to make more sense to finance that. So, $40,000 piece of equipment. Jordan has a credit score of, well, Marty, more than the person in your car loan example, but a
Yeah.
higher score, 762. That's very, very good. The meeting with the local lending officer begins from a place of trust. Perhaps they already have a commercial banking relationship there, which is always advisable. They've got a positive credit score, and that's the place that they're beginning there. Now, remember, Alex has the cleaning company. They have 18 recurring clients that have $5,200 in monthly revenue. So solid revenue for Alex's business. And Alex needs a van. They need a van in order to be able to grow the business. Perhaps it's just in order to be able to get to more houses with all of the equipment. This was supposed to be gender free. I missed this one. So Alex's credit score is 571. And for those of you who may not know about the score spectrum, that's, first of all, less than Jordan's and not a great number. The business has sufficient revenue and a solid customer base, but their recent auto loan application for this van, it was denied. The low credit score has become a barrier now for Alex taking the business to their next level. So, wah wah. That's going to be the difference of what you see, perhaps, in a real life scenario, and that's why score matters. Any other comments you want to make there, Marty?
Yeah, I first reacted to Alex's score as, boy, that's, shockingly low. She's got a good business going already, and we're going to see more about her payment history in a few moments, but it's not uncommon for businesses to be on a bit of a roller coaster in the beginning when they don't have much of a credit history. So it's not that her score is inordinately low. We're going to see the valleys she's gone through and what produced those, but just know that it's difficult to keep your credit at a really high plateau if you encounter times when you need to borrow. When you borrow, your score is going to take a hit. So uh, anyway, let's move along because we've got a lot of slides to get through here. There are 5 basic categories to your score. At some point in your life, you're going to know these like the back of your hand. If you don't already, I want you to become familiar with them. Notice that payment history and amounts owed constitute the majority of your score, but don't disregard the other wedges of this pie. The biggest category where folks make mistakes is length of credit history. It's not even close. The folks that we encounter, and we talk to between 30 and 40,000 consumers a year, a lot of them have come to us having just shot themselves in the foot in the length of credit history category. So we're going to go into these one by one pretty quickly. A lot of this is
Oops.
self-explanatory, but there's a little bit between the lines here that tells you how to improve your credit. The first category is payment history, 35% of your score, so the biggest chunk of all. Notice that they look at the history of each type of account separately. Each type goes into its own little silo, and they say, look, how did you pay your auto loans over time? How did you pay your retail credit, your store cards over time? How did you pay a gas card? If you have one of those for your car, how'd you pay that over time? Everyone goes into its own silo, and we see how you paid those. And that's because, again, credit scoring is about predicting your behavior. It's about if I gave you a loan today, what's the likelihood that you would repay me tomorrow? So, to learn the most about you, they break these down into the type of credit they represent and look at each separately. They also look to see if there are any adverse public records, any garnishments, any liens. Most judgments have disappeared from credit reports back in 2018. They may appear momentarily, but because courts have to keep renewing those, most have disappeared. The thing that really gets the attention of lenders are delinquencies, especially if they're recent. Keep in mind always that FICO's algorithms give the most weight to activities over the most recent 24 months. So if you recently were late on payments, that's kind of predicting what you're going to do if I give you a loan today. If you had delinquencies that existed, 6 years ago, yes, they're still on your credit report. They'll be on for another year, but a lot of water goes under the bridge in that amount of time, and I'm not really concerned about those, and neither is the scoring system. The older those events get, the less they count. You can't erase them. The credit repair companies proclaim that they can do this. They can't. If the entry is accurate, they cannot. So if you had delinquencies, you can't change it. It's the past. The way to deal with it is to add good information. From this day forward, that's what your focus is when it's on credit, and that's what this category is all about. Yes, it says payment history, but recent payment history especially. Underline that. Next one.
Well, payment history. Let's bring it to life in the case of Jordan. So Jordan has 48 consecutive months. If I'm not mistaken, that's 4 years of on-time payments. Jordan treats every due date like a business obligation, is always on time, and Jordan's nearly perfect in this category, which is one reason their score is so high. Alex, 4 years, 48 consecutive months of on time payments. During a period when Alex was temporarily out of work, they missed two payments, both in excess of 30 days. One of Alex's credit cards went into collections, owing $1,200 on the card, but has since caught up. The notations, though, are still on the credit report, and those are the biggest marks against Alex.
So we can keep it on that screen back to
Oh,
that
sure.
table for a sec.
Oh,
So one of the things that I didn't find a place to put on here, but Alex catching up on the $1,200 that she owes and paying off a collection account in full is actually going to earn some points one of the 10% categories that we're going to come to. There never used to be an incentive to catch up and pay an account in collections. Once it hit and was marked in collections, the negative stayed and the damage was done for good. Nowadays, they recognize that that's no real way to incentivize somebody to pay up. So they give you a benefit. It's not a big mover, but if you're a lender, and I always encourage folks to look at their reports from a lender's perspective all the time. Would I lend to this person? Would I lend to me? Seeing what I see? If I see an account like this that went into collections and she owed a significant amount on the card, if she caught up, I have more confidence in her. Yes, she went through a rut. She went through a tough period. Millions of people are missing payments this month. Millions with an M. That's a lot of folks who are experiencing a delinquency. Yes, we try to keep it under 30 days. We never want it to go past 90 days, but catching up sends a different signal entirely. It's really a positive to catch up and make good on what you borrowed. So always bear that in mind. Next up. Okay, so the amounts owed category, the second largest, is really just a fraction. It's often referred to as the credit utilization rate. It comes down to how much of the credit that is available to you is currently being used. We do look at the types of credit separately. So how much the balance is on your revolving credit. Revolving credit is principally credit cards and retail accounts. We also look at how much of your installment loans you've paid off. What's the progress on your car loan? What's the progress on your mortgage? Because at the moment you take out a car loan, you owe 100% of it. So reducing it to a percentage at that day is pretty misleading. So they do treat those separately again, just like we did in the first category. Um, and here, understanding how to improve your credit is very simple. Keep that fraction as low as possible. Keep your balances low, and your scores will go up. Using less than 30% of your credit is always advisable. Um, bankers like anybody else like to see that you actually use the money that you borrow, but they don't like you to see you use too much ever. Now, we know that with Jordan, who's considering a $40,000 loan, the moment he accepts that loan, his score is going to be affected, this category especially. But that's okay. We're going to watch his progress paying it down. The scoring algorithms do that too. The latest version of FICO is one that's called FICO 10T. The T stands for trend. And that version is the most sophisticated yet because it's going to watch his progress paying down that $40,000 loan. And then the next time he goes for financing and takes a sizable loan, his score will not drop as much because the system has recognized that when Jordan takes on significant financing, he pays it down diligently. So when FICO 10T ever catches on, your behavior is being very carefully and scientifically evaluated to predict what's coming next. With him and that loan, it would be interesting to see how FICO 10T would score him because if he pays it down relatively quickly, and the next time he goes for financing, he won't take much of a hit. Okay, next up.
All right, so examples of credit utilization for Jordan. Jordan is using 14% of their available credit. Most months, Jordan makes a point of paying off the business's card balances in full. This not only keeps the credit score high, it keeps Jordan's financing options open, and the business can take advantage of the many opportunities that come its way. So 14% is pretty low. It's definitely under that 30%. Alex, on the other hand, is using 68% of available credit. In the early days of the business, while revenue was thin, Alex leaned on credit cards extensively, paying them down now, but has a ways to go, right, to get under that 30% utilization.
Next up, our third category, and the one that I told you often involves some serious mistakes, is the length of your credit history. I should say the average length of your credit history because it looks at the average age of all your accounts. Uh, and again, we look at how long each type of account has been open. We look at the account activity since you've been open. We don't want to see accounts just sitting dormant for years. Most accounts have a minimum use policy anyway. Uh, but the most common mistake that I see folks make, they close an older account that has a high rate of interest. They'll think, well, this Macy's card or this old American Express account, I never use it. And it's charging me 26% interest. I'm just going to close it. But doing so, especially when that's an older account, reduces the average age of all your accounts, and you take a hit in a category where you could easily avoid it. This is stepping on the rake. You can easily step around it, but some folks step squarely on it by closing their old accounts. Keep them open and performing. Find out what that minimum use policy is and follow it, and keep the balances low, and you'll be fine in this category.
Okay, so length of credit history in the case of Jordan and Alex. Jordan has 9 years of personal credit history, including a secured card opened at the age of 22. So even though it's only used occasionally, just to show some use, it's helping Jordan's score because it's been open for so long. Alex has 5 years of personal credit history and 2 years of business history. There's nothing that can be done to speed up this process, but keeping those accounts open and performing will help in the long run. That gives us some sense of, right? Is that accurate, that kind of duration of time from a lender perspective?
Fourth category is credit mix. This is 10% of your score. We like to see folks manage many different types of credit. We said that right in the payment history category. Because again, it all works towards making your future payment history more predictable, or payment behavior more predictable. That doesn't mean, however, that you should run out and get the different types of credit that you currently lack. To add accounts of a type that you don't have takes years. If I didn't have a retail account, let's say I live near a Kohl's. If I shop there all the time, yeah, I could open a Kohl's card, but I would wait until I'd made 9 or 10 or 11 months worth of payments before I even considered another type of application for credit. You need to add that weight to the back of the pickup truck to give it traction, and then you can go forward again. It's a slow process to build.
So Jordan's car loan has been paid in full. There are also 2 open credit cards, and the business has an open line of credit. So a pretty big credit mix there. Alex has 2 credit cards and 1 store card, but has no installment loans, apparently because they didn't get that van loan. So the credit mix is thin. Alex could benefit from a credit builder loan, a tool that we'll be discussing at length next session in session 2.
And our fifth and final category is new credit. This really looks at the number of hard inquiries into your credit. Those are applications for financing that you initiate. Almost every time you apply for credit, a hard inquiry is going to pop onto your credit report, and it's going to stay there for 2 years. FICO's formulas only count those hard inquiries for the most recent 12 months. So, for months 13 through 24, they aren't even factored into your score. Other lenders can see them, but it's not going to impact your score at that point. The reason that this category matters is because if you have a lot of inquiries for financing, especially over a short period of time, it looks like you're desperate for cash. Even though the purposes might be perfectly legitimate, it can create that interpretation, and that's what we want to stay away from. There are 3 types of installment loans that are given special consideration. So student loans, car loans, and mortgages are batched together generally in 30 to 45-day windows. The older versions of FICO, the oldest versions batch them together in 14-day windows. Most FICO formulas use 30 days, and the newest ones use 45-day windows. And by that we mean, in a 30-day window, for example, I could fill out a car loan application every day for those 30 days. It would only count as 1 hard inquiry. The same thing for student loans. Those of you who are parents who are applying for loans for the fall might be hunting around with private lenders and filling out applications. If you do that in a judicious way or disciplined way and confine it all to a calendar month, it will only count as 1 application. That's called deduplicating or deduping, and it's a consumer-friendly practice. They don't want to see you hurt your credit while you're shopping for the best interest rate, because these are all big ticket items that you really do want to shop. So the system is not going to penalize you unduly for that. Next up.
So Jordan just made 1 application for credit in the past year, a car loan. That inquiry was made 6 months ago. Alex's credit report shows 3 hard inquiries in the last 12 months, including the van loan application that was denied. So when a consumer has relatively thin credit profile, not many open accounts of any kind, even minor negative marks can cost them a fair number of points. No one, especially a car salesperson, can ever predict how many points you'll lose for any particular action you might take. And I love that that's noted because I have been made promises by car salesmen specifically in the past.
Same here. I was followed it during the holidays by a nice older woman who told me, just sign up for our card. You can save 10% today. At that time, my wife and I were looking to replace one of our cars. And I said, look, I don't want to open any new credit at this time. We're just about to make our application. She says, oh no, it's not going to impact your credit. I'm like, oh no, I don't have time to stop and explain this to you, but don't tell that to anybody else. It's just not true. Uh, it can be a roller coaster ride when your report is thin, when you don't have a lot of open accounts, but you'll get past that by adding accounts slowly. Uh, so let's look at the range of scores. We mentioned those in the beginning.
Yep.
When people ask me what's a good score, the correct answer is whatever the lender's looking for. But do know that when your score is relatively low, it can be like wearing a bullseye on your back. You're going to be targeted by some lenders who don't mind. They're charging you exorbitant rates of interest. You
And
have
I can say we call that predatory, Marty.
It is predatory lending. But yet you need to go through that spanking oven to get to better rates at the other end of the tunnel. You need to experience that pain a little bit, but we want to limit it by building credit slowly and limiting the pain that we have to experience to get to a great score and really excellent rates.
You know
Uh,
what? I also want to mention, can I insert something, Marty, from our experience when we've seen business owners who are in one of these lower tiers or tougher credit situation, they are often very attracted to scenarios that don't factor credit at all. Remember, we said there was just a small percentage of lenders who aren't looking at those scores. Um, and one such category of lender that I consider predatory is, in certain cases, these point of sale platforms for retailers where the lender is suggesting you can pay back this lump sum amount just as a percentage of the revenue daily. And that can be a really attractive option when a business owner is looking for fast cash and either can't get through the lending process in a timely manner, or it doesn't look very appealing based on whatever the credit health situation is. And so what we find, though, is as attractive as it is in the short term, it's a long term, very painful type of product to participate in, and creates a cycle that's difficult to exit from. And furthermore, most lenders aren't going to help refinance that type of a loan to help you break the cycle. So that wasn't part of the slides, but like if I can help stop one person from doing one of those point of sale cash advance type loans, then like I'll feel really good about myself this week.
Yeah, we should add that in before these are posted because the revenue-based loans are trouble. Anytime a lender is not looking at your credit, that's a red flag, frankly. So, uh,
Not always. We have credit builder loans who
oh
may
no,
be looking at some other factors, right?
right,
So there might be a category, but then if it sounds too good to be true, we
right.
know
If
the
it's not
rest
a
of that
credit builder
sentence.
loan specifically, then it might be
That's right.
worth it to look the other way. Uh, so I mentioned that there are lots of versions of FICO formulas. You're going to see references to these score names and maybe not recognize them. Just get used to it. Each of the bureaus produces what they think of as a branded score. We're only interested in the fact that it's a FICO score. Do know that when FICO rolls out a new formula, each bureau gets a customized or semi-customized version of it. So when they introduce a new one, it's not one new formula, it's really three. Some industries produce industry-specific versions of FICO. Some mortgage lenders have done that. So there are lots of them at play. Don't be frustrated by the differences. most of the differences arise from the differences within your credit reports themselves, because credit reports um, have different quirks that we're going to look at in a moment. Next up. So the score is one thing, and the score is based on what you're in your report at that moment. But lenders like to see the big picture. They like to look at your full credit report, or should, depending on the type of financing you're going for. They're going to look for late payments, for settlements especially. Settlements are credit killers. Uh, I know we've all seen the ads for companies that promise to tell you the secret the banks don't want you to know. The fact is that there is no right to settle a debt in this country. That does not exist. That's the secret. But they are willing to charge you a fortune to settle a debt and break your connection to your lender and crush your credit for who knows how long. And you won't save much money. Uh, so settlements are a red flag. Collection accounts get people's attention. Charge-offs, when accounts are sold to collectors, each tells a different negative story about you. Credit use, the same. That 30% category is also something we have an eye on, but we also want to look at how did you encounter it. In Jordan's case, that $40,000 loan is going to, push his credit use up dramatically, but we're going to see that it was for one piece of equipment. It was from one vendor, and we'll be satisfied that that's what it was all about. Uh, you need to occasionally know how to explain your report to a lending officer. What was going on in this period? They may ask you questions about it. You really need to get comfortable interpreting your own report so you can explain different periods, different activities during different periods. But again, ultimately, we're looking for a consistent behavior, and we're focusing on those most recent 24 months. Let the past worry about itself. If you're looking for specifically for business financing, and this is something where, we could do several days worth of how to separate personal finances from business finances. And there's always an intersection that needs to be acknowledged too, a period where your personal finances are really carrying all the weight. An SBA lender is going to look for a score of 680 or more. Uh, they're going to very likely pull both your personal and your business credit. So both matter and both need to be maintained in good shape. When you get your first business credit card, use it to pay your business's bills as often as you can, and then pay those balances down in full every month. That'll build credit pretty quickly. Uh, Dun& Bradstreet, which produces a business credit report, looks specifically at that fact. Like it focuses on how quickly did you pay your vendors. So you focus on that, and you'll maintain a high Paydex score. That's the Dun& Bradstreet score. Your debt to income ratio is also crucial. Notice income wasn't a part of your credit reports. It's not there. That's one of the great myths about credit reporting. Your income doesn't matter. It's really how you pay your bills. Somebody with low income can have a 750 score. Someone with six-figure income can have a 500 score. That's just the fact, and that's why income doesn't appear. Next up. The three major bureaus, Equifax, Experian, and TransUnion, aren't the only games in town, but they are the three major bureaus in the US. None of them is really particularly any better than another. They do the exact same work the exact same way. Again, you get your reports for free every week now at annualcreditreport.com. The biggest problem with this process is that reporting is voluntary. That's very frustrating for consumers who may pay a bill faithfully every month and discover later that it's not being reported, so it's not helping your score. The biggest not violator, but the biggest type of account that's not reported is rent. A lot of folks have rent from a small town landlord. somebody who doesn't own a lot of properties and they don't know how to report to the credit bureaus or are too busy or uh, whatever the reason, your rent payment, your biggest payment going out the door every month isn't being reported. There are ways that we'll show you over the next two sessions to remedy that situation and make sure that your rent is reported and you are getting credit for that. And you can show uh, consistency there. One of the nice features about rent reporting is that they will go backward, for a pretty modest fee, about $125. They'll look backward and report 2 years worth of prior rent payments, which will jumpstart your credit. Adding 2 years worth of the magic number, 24 months, 2 years of on-time payments would really give your credit a kick. So we'll spend time on rent reporting, but the fact that reporting in general is voluntary is really frustrating. You can always contact creditors and ask them to report in return for your on-time payments. They can do that. The mistakes that happen will come from out of the blue. At one point in time, they had me living at two addresses in my hometown. My first inclination was to question that, like, why would they think I would live at two houses in the same zip code? But it's just symbolic of the fact that they don't question anything that's reported to them. They
Anyone can
read,
report anything incorrectly, right? Like I had a lender, or it wasn't my lender, a lender keyed in another borrower's social security number. It was one number off from mine, keyed in my social security number for her name. It was, I don't know if y'all remember those gateway computers that used to come in the cow
yeah.
packaging, but they'd apparently bought a gateway computer and like never even made their first payment. And it was, I had no idea till I was applying for a job that checked my credit. And they said, like, you have like a 560 credit score. And I was like, what?
Oh,
So this person had their our credit report histories, all the stuff got like melded together because one person one day keyed in the wrong social security number, and it was quite an effort to untangle it. So checking,
we
you
do see
never
that.
know what you're going to see.
Yeah, with fathers and sons who don't use a junior or senior, happens all the time. Um, Fixing reports is easy. In my case, I just showed them that the second street address doesn't even exist in my zip code. It was just a clerical mistake. Those happen constantly, but they still can impact your credit. So removing them is
Necessary.
necessary, but it is free. You may need to document it. You can upload copies of your documentation. You don't need to send originals of anything to the credit bureaus. They're not legal entities, but fixing them is supposed to take just 30 days. It often can take longer. There are a couple of lawsuits right now in the works because it's not taking 30 days always the way it was supposed to. But for whatever reason, um, as consumers who are and business owners are trying to get our credit moving, sometimes it's just faster to go to the merchant involved. If it's a balance mistake, go to the merchant directly and say, hey, I've got a statement showing my balance is, $25. You reported 2,500. Obviously, just a typo. They can fix it by next month's report. If you have questions about that, we'll take care of those in the next two sessions.
Well, we
We're
have
doing
one question in the chat. I wonder
reported. Mhm.
wonder if we could answer. So, and it references on the slide. The question, Anna Alfaro. Hi, Anna. She says, "Do you know if there's a free link to report rent? Some landlords offer it for a monthly fee." The last bullet on the slide says, "Ask the creditor to report. It's free." So, is it free for the creditor to report the credit payment history?
Yeah, it's free. It's reporting is free. They want to remove all barriers to do the reporting.
The
The
creditor. Oh,
landlords have been, some landlords use services that charge them.
I
Uh,
see.
in the next session, we'll show you rent reporters they only charge $5 or $6 a month. It should never be more than that. So if your landlord is trying to charge you more than that, there are other services you can use like Isuzu or Rental Karma or Report My Rent or Rent Reporters. There are at least a dozen of them. And the one thing they have in common is they are cheap. They're really inexpensive. So for $5 or $6 to have my rent reported, again, my biggest payment, uh, is more than worth that price to add it to your report. And again, for like a one-time charge of about 125, they'll go back and report up to 24 prior payments. Rent reporting is a good deal. And the government is using it now. They use Isuzu for FHA finance properties. So worth some research on your part if your rent isn't being reported. Next up. Although the reports look differently, almost always they arranged differently. They basically contain the same type of information. The accounts that you have that are in good standing and open, the accounts that have closed, the accounts that are in bad shape, any personal records that indicate a debt, like a bankruptcy, a Chapter 7 bankruptcy will stay on for 10 years. The Chapter 13 bankruptcy will stay on for 7 years. They'll show recent applications for credit. And I should have mentioned when we were on that slide, auto lenders, especially now, have finally discovered that they can do soft credit pulls also, like mortgage lenders have done for decades, and not impact your credit. So look for those folks because they aren't kidding. Really won't impact your credit if they're doing a soft pull. Those are interesting when you see them on your report. Uh, Basically, it works like this. And this goes to the question of why are they giving credit reports for free? When you go out to your mailbox and you see an application for a Chase credit card or a Bank of America credit card, if you were to get your report that day, you'd see that last month, those two banks looked at my credit report. They bought access to it. A bank buying access or a lender buying access to your report doesn't impact your credit. You didn't initiate that inquiry. They did it on their own. That's how the bureaus make money. And just for easy reference, let's see, if I give out free credit reports to 200 million American adults in a year, you'd think that's a lot of money that I've just given away. They sell about 5 billion reports with a B to the banks to make credit offers to you in a given year. So, so credit reports to consumers, it's a tiny blip on the radar. Their biggest market is selling directly to creditors who have to have a permissible purpose, and that purpose is to make a loan offer to you. So that's why it doesn't hurt your credit. You had nothing to do with that, them buying their access. Personal information is the category where you're probably going to find the most mistakes. Do review the addresses that are listed because bills are associated with addresses. And we don't want to see mistakes creep onto your report, so be vigilant. For folks who have a military background and move from base to base to base, I know this is really frustrating for you, but do that work anyway and make the corrections. Next up. Some things you might notice over time. You might see a hospital didn't report your account, but a collector did. The hospital, again, they aren't obliged or required to report your debt. No creditor is, but collectors usually do. So when they buy your debt, they will start reporting because it's one of the two tools they have to get you to pay attention. The other one is suing you. Uh, Accounts listed that don't belong to you. This is an easy indicator of identity theft or mixed identity. Uh, that's a touchy subject. If you do have identity theft, you go to identitytheft.gov. It's a great website. It used to be part of the FTC's website, but it kept crashing the site because identity theft is so rampant. So they split it off. It is a great website. It has a triage feature that where you can tell them as much as you can about what you've experienced, and they're going to steer you to the types of documents you need to file. It's really a very good site. Uh, you may see accounts move from one collector to another over time. One collector wasn't very aggressive, you didn't pay or you didn't pay attention, or they didn't know how to contact you because you had moved. And that same account is sold to a different collector a year down the road. That's common. We used to have to track those by the balances. They're supposed to list the original creditor. That's the easy way to track what this account is all about. Oh, it's that, old Verizon account that I forgot about. Here it is with this collector in this year. Here it is with another collector more recently. Time to do something about it because it's not going to drop off on its own until 7 years have gone by. We're going to look for those accounts that are still present that should have dropped off. We're going to look for balance errors, for payment histories that aren't quite right. Um, Companies or creditors, computer systems aren't perfect. They may have you missing payments when you made payments. That's just points to the importance of keeping good records, especially for your business. Uh, Disputes are free, and we're going to show you how next time. Until then, please make a promise never to go near a creditrepair.com or a Lexington Law type of operation. I specifically mention them by name because I've testified against them in several states. They do the devil's work in the worst way. They charge you for something you can do for free, and they charge you in advance when by law they're only supposed to charge you 6 months after the change has been made to your credit report. I can say with certainty, none of them operate that way. They all violate the law. And worse, they goad you into violating the law also. You're never supposed to challenge a negative item that you don't have some legitimate reason to feel is inaccurate. I can't challenge something just because it's a couple years old. That's not a legitimate reason. If the balance is accurate, I can't challenge it. Just to see if the creditor will respond. That's fraud. So, and again, they're going to tempt you into doing that and charge you $100 a month, basically until you tell them to stop. They'll be happy to charge you forever when you can do all of this work and wrap it up in just a couple of months for free. So they have a special place in my soul for those guys. But by the end of these sessions, you'll know how to take care of that by yourself. It's not difficult. Next up. Oh, we're already getting there. Okay, I thought we were going to be way behind. So these are some of the other services that my agency offers, and I'm grateful to the Association of Women's Business Centers for just letting us include this. We have lots
Well,
of good services.
and I'd like to kind of put a blessing on what you're about to say, Marty, because your firm was brought to us by a women's business center who's federally funded to provide support to businesses who are getting started and growing. And through the work that this women's business center is doing to really help businesses who are trying to grow, they found you and have had great success. And so that's how we were introduced to you and why we are happy, to introduce you. And, I think it's worth mentioning that Cambridge Credit Counseling is also a nonprofit like us and like our women's business centers. And so it was really important to us that we not introduce a predatory agency or a predatory actor into this field and really only offer something that's beneficial. So just wanted
Yeah.
to say that before you share all of these services.
I appreciate that. I thank you very much. I won't go into each of these services individually. I will say our student loan counseling is free, and I do lots of that these days because of all the changes that have taken place. During the pandemic, we started working with several teachers' unions because we needed to fulfill our educational mandate as a nonprofit. So while everybody was staying home and huddling together on Zoom, we delivered our student loan counseling for free, and we still do it for free. And if you see scroll back to my contact information after this is posted, you can call me till 10 o'clock at night. I'm a former teacher. I'm used to getting calls and only being free after dinner. Just you can text me at that number too. It will be free. Our credit counseling and debt management programs were specifically, and you can go to the next slide, please, are specifically included for this one because if you're in the spot in your life where you need to work on past accounts, or you're using a lot of your credit, you're maxed out on accounts, and looking to bring down your balances, but it's difficult because the interest rates are so high. That's what we do. I'll show you how we do on the next slide. But basically, we're going to make you, the cost of all this is we're going to make you do a budget. And when you talk to a counselor, they're going to put you through the budget process because we know that a lot of folks are out of touch with where their dollars are going. You need to have an accurate budget. If you do have a good budget in place, that part of the process goes by quickly. But we aren't going to judge your spending priorities. Those are your own. We just want to make the cash flow within your personal finances or your business finances or both. We're going to try to make those make sense and get you moving toward your goals. Those should be consistent with each other. So unsecured debt is, again, it's credit card debt, debt without collateral. In a debt management plan, which is our principal tool, we don't settle debts. We will work with your creditors to reduce your interest rates because you're working with us and going through counseling. They'll close the accounts that you designate for closure, and they'll drop the interest rates on those to an average of just around 8%. That difference, if you go to the next screen, that difference makes a substantial change in the monthly payments you have going out, and in the time you would take to repay in full on your own. On your own, it might take you 20 or 30 years to repay a huge balance, a substantial balance. But through a counseling agency, a nonprofit like Cambridge, our average is around 48 months right now. Our workout plans can stretch out to 72 months if you need to go that far, or they can be much shorter. They could be 36 months. But generally, people finish around 4 years because, the creditors want to see that you really do need the assistance and you don't currently have enough money to pay at 25% or 26%. So the concessions they grant, which are really, no one's forcing them to do that. Your creditors are working with you, and that's the advantage that our type of workout plan has over settlement. Settlement isn't a workout plan. It's a way of cutting your ties to your lender. You never want to do that. Credit counseling saves money, actually saves money, and you will gain points over time. Again, I promise not to predict how many. We have studied our own client bases across the industry and found that, as you'll see on the next slide, at enrollment, people only lose generally 19 or 20 points because, again, they've already maxed out their cards. So think in that 30% category, they're approaching 85, 90% of their credit use. So their score is really suffering. By paying over time on a monthly basis and not missing, they gain back about between 40 and 60 points over those 48 months. So again, it's not a quick fix. Either of those don't exist outside of rent reporting. That's probably the best one I've ever found. But debt management plans work, and they're a great tool. There's no exaggeration. It's not as quick as you might hope for, but it's reasonable because things are going to happen to you during those 4 years. That's what our type of plan and acknowledges. And creditors know that, yeah, if you miss a payment, we're not going to kick you off immediately, but we don't want you to miss more than a payment. We want to make sure that you're learning how to manage your credit appropriately during the time that you're working toward a zero balance, which is what we're about. Do we want to get to the Q&A?
Sure, we can do that. And I also put in the slide the way to connect with Cambridge Credit Counseling. We have a dedicated partnership with Cambridge Credit and a page where you can drop your information in to these fields, and that'll ensure that we have a tracking mechanism to be sure you don't get lost in the shuffle. Make sure that you get your concern basically handled. So I wanted to make sure everybody was aware of that. And then, so I'm opening it up for Q&A. Feel free, you can raise your hand, you can pop in. But I also have a couple of questions that came in through the registration process that I was going to address as well. Number one, if you'd like to work with someone locally in addition to Cambridge and some of the information you've heard today, we'll be providing some information on how you can find a women's business center near you. We have 140 of these nonprofit women's business centers that I mentioned that are federally funded. That means they're subsidized to provide services for you to help start and grow your businesses. Many of the services are free. We'll provide that information in the follow-up email for everyone who is registered. There was a question about if today's session will be recorded and if we'll provide slides. Yes, it is, and yes, we will. The process is a three-part session of education. We'll be providing resources just like we did today throughout every one of these three sessions. If you're not able to attend one, once you registered, you'll go ahead and get the recording for those as well. Some of the topics that you're going to hear about in sessions 2 and 3 will be more about some of the business credit mechanics. Marty already mentioned about Dun & Bradstreet. We'll be talking a little bit more about that in session 3. We'll reference some nonprofit credit in session 3. I think there was a question that came in the registration process about if any of this information applies to nonprofits, and session 3, we will have a brief call out about that. Some of you are considering a home purchase, home equity. There's a generational wealth component in many cases to what your considerations are for your business credit as well. And so there will be some information about these credit concepts that apply, even though this business series is technically, or this series is focused toward the business angles. And then I did get a specific question about food trailer startup and some bookkeeping vendor questions. And we will not be addressing that specific example in our series, but we do have a great way for you to reach out to us about questions specifically about whatever aspect you've got questions about to help you grow your business. And so I put an email address in the chat for you there. We're happy to help you at our business facing and business growth platform called Hope to Women. It has women in the name, but anyone can email us there. We're happy to hear from you and talk about any of your specific business questions or ideas. Yeah. So do we have any other question? I think there was a question. Marty, I don't know if you can address this. It was like sometimes why questions are interesting. Sometimes we can't know why things are the way they are. But Bridget Foster asked, I think she was referring to the credit reports from the different 3 bureaus. Why don't they all have the same information?
And that is one I can answer. It's because as a creditor, I can choose to whom I report. If I like TransUnion, I just report to them all day and exclude the other 2. They are not required to share that kind of information with each other, but when you fix mistakes, so let's say I have a mistake on my TransUnion report and I go through the process of fixing it, they do have to share that information with the other 2 bureaus. That this was reported to us incorrectly. Here's the correct information. Fix it on your reports if it appears there. So it's the vendor's choice. It's the creditor's choice to whom they report, and that's why they will be different periodically.
Yeah. Well, I guess now we know why. I don't know if we feel better about the world, but they are different. I know we've gone over the hour. I think it was necessary to hit all of the points in full. Marty, thank you again so much for contributing this. And it's obvious you have a lot of experience in this area, and we've only scratched the surface kind of at this foundational level. I'm really looking forward to what else we're going to learn in session 2 and session 3 together. And I also want to thank my team, Jackie, Madison, and Chelsea, for all of the work in helping us get prepared and launched for this great session today.
Great to meet all you, and thanks, Corinne, for bringing us together.
Yes, I'm going to say, Jeanette Norwood, with your question, are you able to help with a student when you sign for an adult
student loan? I meant loan.
Student loan? Yeah. I don't know if that's something, Marty, you can address, or if you want to follow up
Jeanette,
later after.
I just need to help in what way?
With the paying back the loan. Tell us how we can do.
So that's one of the things where there are a lot of scam artists out there, looking to charge you 1% of your loan balance or 5% of the loan balance. Um, we cannot help you repay your loans.
Okay.
That's no one can,
No, no.
except for an employer. So if where you work, you can ask, do you participate in reimbursement for student loan payments?
Hmm.
Some businesses are using that tool to attract and retain employees.
Very
That
nice.
doesn't hurt to ask. I would say that if you're having difficulty, an income-based repayment plan is usually the best bet. Have you already borrowed?
Yeah, it's already been borrowed.
And were
And they
those
were,
Parent Plus loans?
it was through Wells Fargo when they shut the student loans down and sold them to
So they're
someone else.
private loans. Okay, so um, my personal contact info is on there. There's not a lot
Hmm.
you can do for private loans except
Hmm.
maintain great credit, improve your credit, and refinance them. Uh, there are a dozen or more really perfectly reputable private lenders who will refinance.
Okay.
You might want to look for something called a co-borrower release option,
Hmm.
which means that if your son or daughter makes the first 24 or 36 payments, you are released from the loan. And that's important because if you're going to start a business, you don't want that debt attached to your finances. So if your son or daughter becomes, financially stable and they take over the payments and you're excused from the loan as the cosigner, now your credit doesn't show that debt. So feel free to contact me. We can go through it.
Oh, well. Awesome. Awesome. Awesome information. Thank you so much, Martin.
Welcome.
Okay, well, I'm going to say, I know there are more questions. We've provided some contact information. Was so great to have everyone here. I'm going to use, I guess, the old phrase like, you don't have to go home, but you can't stay here because we're closing this one out. It was really great to have everyone. And I want to say a thank you also. I failed to mention this in the opening, that US Bank helped fund the work that we did in preparing for today's session. So I want to thank you to US Bank. And so you'll see their logo added to the slides when we send them out. Hope you all have a wonderful rest of your day, and we can't wait to see you again in session 2. Talk to you soon.
Thanks, Karen.
Thank
Bye.
you.